Welcome to another episode of Equity Mates, a podcast where we explore what is possible in the world of investing. If you've just joined us for the very first time, we have a massive episode for you today. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. We have a returning favorite expert investor joining us in the studio. He's spoken to us about stocks that he does hold in his portfolio before. This time he's also going to tell us about a couple of stocks that he doesn't hold, including one that is very close to your heart, Bryce. So I'm looking forward to that debate. But James Abela, welcome back to Equity Mates. Thanks for joining us again.
Thanks very much.
So James is the portfolio manager of the Global Future Leaders Fund at Fidelity Australia. And we're going to cover all things midcaps today, James, part of the market that a lot of the Equity Mates listeners are interested in, and a lot of content about the growth opportunities in that part of the market, particularly the small caps, or the safety of the large cap side of the market, but we don't often focus on that mid-cap, area.
Yes.
So what is the case for mid-caps?
Look, the case for midcaps is they are more mature, they're more established. The management team has been through a number of cycles usually. They usually, for us, they've got 20 years of history that we can look at. Smalls just have less in everything. Maturity, corporate profile, history, establishment, balance sheet strength, competitive pressures, all those things. So for us, they're just a better, more mature asset class to invest in. But we do mids and smalls. So mids goes up to now 60 billion US. So when we started the fund, 28 billion was the biggest stock. It's now 65 billion US.
Wow.
Which is obviously 100 billion Aussie.
So basically, I was going to say a global mid cap is in the ASX 10.
Yeah, I think it's on the verge because I don't do Aussie large caps. I'm not sure, but it is very close to it. Like some of the banks are in our index.
Yeah, right. Okay. Yeah. I mean, that's a reminder why you invest globally, isn't it?
Yeah, it's just the scale of it is huge. So yeah, that's the top end, 65 billion US, and the bottom is around 5 billion US. And smalls actually has an overlap now, so that's 12 billion US down to 1 billion US.
Yeah.
And we actually go from 60 billion down to 1 billion.
Yeah.
Wow. So it's a big spread. It's a big spread.
Yeah.
And so we've spoken about the Global Future Leaders Fund with you before. Yeah. It's actually reaching its 5-year anniversary.
Yes.
So happy anniversary. In September. So now.
Yes.
Yeah.
This month.
It's been a wild 5 years. If we think back, September 2020, we were all probably locked down at that stage, living through COVID, masked up. Then we had the absolute bull run that was 2021.
Correct.
We had the crash, and it's particularly in tech stocks and sort of unprofitable tech stocks. We've had rate hikes. What else have we had? Australian properties probably doubled in that time. Geopolitical tensions. We've had wars in the Middle East and in Europe. It's been a busy 5 years.
Trump tariffs.
I forgot about Trump. How's the fund gone through those 5 years?
Look, we've navigated pretty well. It has been a very unnormal, shall we say, unusual, volatile 5-year period. It's been pretty wild. Yeah, markets up a lot, markets down a lot. Market very bullish, then market very fearful. Recession fears also in that whole period. So we navigated that pretty well, especially in the up tech years we expect to do well, but the down tech years we also did well. So 2021 until 25, we basically outperformed every single year, and the markets have been up between 20 and then also down 10 to 15%. We've been between flat and up 5% every year
on the market.
On a net basis. So that's been very encouraging for us, and it really goes to our process, which is we call quality value transition momentum, which is a blended style. It's a very balanced style. There certainly were peers and products in the market that are up 10 to 20% on the up markets and then down 10 to 20 on the down markets. And our goal is to be a bit smoother than that and to not sort of lose a lot when the market comes off. And it's easy to be, when the markets are going well, quality momentum cheerleading feels really easy and it feels good because that's what's happening and you're winning basically. When that's happening, we try to trim back a little bit and try to be a bit more modest. And that's why that balanced style has worked in these very volatile 5-year period.
When you reflect on the last 5 years, like, are there any sort of new learnings that you sort of take away when it comes to, building that resilience?
There is. The structure's similar, but the valuation paradigms are something that you got to think about, I think, much more broadly now because of technology and the way technology, the evolution of valuations in the technology space has evolved a lot. The market now looks at cash flows. It looks at like a company that was loss making. It's very hard to get valuations up, but now, like today, we will talk about Roblox. It's $100 billion stock nearly, and it loses $1 billion a year. But that's what it is, and that's a technology business that's successful. The paradigm in technology in particular on terms of valuation is what you need to think about in a new sense. But in terms of the structure of our portfolios, we haven't changed a lot, but that is definitely one of the big lessons that you can learn.
Yeah, nice.
Yeah, I mean, the inflection from unprofitable tech to profitable tech.
Correct.
And just how quickly things can change there. Like
Correct.
Uber is the classic example of
Yep.
it just
Uber
went
is-
from money losing
Yep.
to meaningfully profitable.
Correct.
Yeah.
So the big ones we've looked at, Roblox we can touch on, but Spotify was
Yeah,
one that we
that's a
looked
good
at
one.
and we
Yeah,
didn't
yeah.
own it, and it went up 6x before our eyes.
Yeah.
One that we did own, which is a big success story of ours, was AppLovin. We bought 2
Oh,
years
yeah.
ago,
Oh, yeah.
and
Yeah,
that
yeah.
one has gone up 500% in the last 3 years.
Jeez.
And it is exactly what you just mentioned, Ren, there. It was loss-making, and then, so we look at ROIC a lot, return on invested capital a
Yeah.
lot, and that was making minus 10 to 20% returns every year. And then it made 5, and the next year it made 50.
Wow.
So, like, in terms of profitability, its sales were going up in the billions, and the profits were going up in the billions,
Yeah.
like, basically within 12 months.
It's nuts, isn't it?
And that's what can happen. And that's with technology. It can be a network benefit, the flywheel benefit, and you just reach a point, like you mentioned, and then whoosh. And it can be enormous.
Yeah.
And so for AppLovin, which is still in our fund today, it makes a 60% return on capital, $100 billion stock. But 3 years ago, it didn't make any money.
Yeah, AppLovin. I've told Bryce this story. I get PTSD about that one because it came to market in 2021. I'm pretty sure, and it was like in the boom year. And I remember seeing it come to market and thinking, "Wow, anything can list these days, even companies called AppLovin."
It is a funny name, but yeah, it's amazing tech. Like very, very smart developers in it, and it was up again. The last few days, it's been up quite a bit.
Yeah.
Now it's actually 165 billion market cap. For me to correct myself,
Nuts.
165 billion market cap.
Yeah.
Wow.
And the earnings, 3 years ago negative, and next year it's like in the $10 earnings realm. So like $10 a share. It's a huge change. It's a huge change.
Well, I'm sure we're going to talk about tech a bit more. We flagged Roblox as a company we want to come back to, but let's just talk about midcaps generally. Just touch on them quickly. So, why mids? Why not go even smaller and look for those undiscovered ones? Why is mids a compelling hunting ground?
For us, look, it's more about maturity. The maturity of what we can see. So we like to see 5 to 10 years of history at least. The average age of a mid cap is around 28 years old. The average age of a small cap can be around that 10. So we call it the land of teenagers, which is can be amazing, but it's just a bit more volatile. So maturity, balance sheet strength, all these things. Whereas you have that 28-year-old company, on average, it's just a bit easier to see where it's going to go. But then, for example, like AppLovin is a 10-year-old company. Like there are exceptions to these rules as well. That's just a broad comment. And we have been down. We do own billion-dollar companies as well. It's just the index we chose is that mid-cap index rather than small-cap index, which is a bit more whippy and it's just a bit more volatile. But we do find the mid-caps where we tend to hunt mostly as, safer, more developed, more mature. So that tends to be why we stay in that area.
And you've described mid caps as having your cake and eating it too. Is that what you mean? You kind of have the growth, but also a little bit more resilience than the small cap side.
You do, and it's also still very undiscovered. So in terms of coverage by the street, it's still very low. Like AppLovin, when we bought it, and it was a $20 billion stock, there was hardly any coverage. There was maybe 3 or 4 brokers on it. Today, it's 160 billion. There's over 20. So that's why that sweet spot between that $5 to $30 billion range tends to be a sweet spot that you can get real. And it amazes me what Maroon and I can find now. Is still, you find businesses that 20 times multiple stock, 20% ROE, growing at 20% a year in a market where there's maybe 5 or 6 players, and it's there and it's been growing for 10 years, and it's just amazing that actually exists.
You wanna drop
but it does, and there's not just one of them. There's a lot of them. Even these AppLovins and other companies that we've had, like Arista, they're just great businesses, but it's just because of their size that they're a little bit underdeveloped, under-researched, more. So that's where, there's a huge opportunity set. And there's about 4,000 stocks to buy from. So compared to, say, the Australian market where there's, 200 to 300.
Well, let's tease that at the end of this episode, we're going to talk about one company that has had an unbelievable run.
Yeah.
And yet I reckon still probably in your mind fits that definition of a bit under-discussed and undiscovered.
Yep.
So for people stick around, we'll do a deep dive into a stock towards the end.
Yeah.
But let's talk about the market today, because over the past 5 years, we've had, inflation concerns, geopolitical, we've had technological disruptions and crashes, we've had all this stuff happening. Well, a lot of that is true today as well.
Yes.
I feel like things have probably never moved faster than the moment we're living through.
Yeah.
So how do you position a fund for a moment like this when there's so much concentration in a market, there's so much uncertainty about what's happening next, and it seems like every day the news has something new for us.
Yeah, we still go back to fundamentals, which is what we call the basics is sort of VSC: viability, sustainability, credibility. Viability is good return businesses that are either high return businesses that are going through this hockey stick of returns that you mentioned, so loss making, a little bit of profit and a lot of profit. So they're innovators. They're beautiful compounders of those high return businesses, or they're cyclicals that are going through a cyclical uplift in return. So you need to have that viability trend in your favor as an investor. So either high return, innovation, or cyclical. Then sustainability is how long that lasts for. So if it's short term or a long term or structural winner. And then credibility, trusting yourself to make judgments out of those first 2 things, but then trusting the accounts and trusting management. If you can find those things, you can find future leaders. And that is what we try to do every day of the week. And we've made money in all of those 3 sort of dimensions of future leaders, which is beautiful compounders, structural winners, and then cyclical winners, and then innovators. And that's what we really try to do. So in the spread of the business today, it's very similar to the portfolio, like a normal portfolio. We have quite a lot in consumer, quite a lot in financials, quite a lot in industrials, and quite a lot in tech. Those 4 industries are around 20% of the fund nearly each, and they have been through time. And that's where you find this blend of beautiful compounders, innovators, and cyclical winners. And that's really what you end up coming back to. The market's still very well valued, free cash flow yields are good, the multiples are still good, and the growth is double digit. So that's why it's still pretty attractive out there.
So then, James, part of Ren's question was around, a lot of macro sort of things that are going on.
Yep.
Does macro then not factor in at all with portfolio construction?
You've always got to think about it. It just doesn't drive us. So at the moment, there is quite a lot of macro. The macro trends come down. Industry is really US housing was a big concern that was very negative, say 6 months ago, but now rates are coming down. It's getting a bit more positive. Consumer fears, recession fears were real. We forgot about them almost now in September, but in February and March, the market was incredibly concerned about consumer cycle and fear of recession, and that's sort of dissipated quite a lot. So you do have to think about these things. We just tend not to, trade or lean in a certain macro way. We do tend to be more fundamentally based. And then the cycle, obviously, you got to think about. So the cycle is very real in terms of macro. So we do think about it, but it just doesn't drive what we invest in.
How much do you think about the will they, won't they trade war? The on again, off again
tariff
situation?
Were lucky in our portfolio. We just didn't have a lot of direct exposures to that. Okay. So the big ones were drug importation in terms of manufacturing offshore, importing into the US. Then there's consumer products that you make outside and then import into the US. And then there's ones that import a lot and then redistribute within the US. And those three categories of high impact, they just didn't affect us that much.
Yeah.
So we didn't actually trade anything directly related to tariffs. And all of our medical investments in healthcare were medical devices, not pharmaceuticals. So yeah, we were just the way the portfolio was structured, we didn't have a lot of impact in that tariff environment.
Yeah, right.
Which was good.
So, James, at the start of this conversation, we said we were going to talk not just about companies that you own, but some that you don't own as well. And I think it'll be useful because it will illustrate your process and how you eliminate companies as much as the ones that you do include in the fund.
Yeah.
And the one that you suggested was Roblox.
Yes.
Now, for context, Roblox is a stock that is close to Bryce's heart. It was his stock of the year it listed.
Ages ago.
And it did pretty well.
Yeah, it had a decent run.
Probably should have kept it in the portfolio because
if you held on, you would have done very well.
It's now got over $100 billion market cap. But I think for people who are maybe our age, maybe don't have kids, they may not be super familiar with Roblox. So for starters, just tell us what the company is, and then we'll sort of unpack why it hasn't fallen into the Future Leaders Fund.
Yes, so we have not been an investor in this. It's been a huge success story. The business has executed well. Why we don't own it is just it's loss-making and there's a lot of share dilution because of shares that are given to developers, for example. So because of that reason, we didn't see enough profitability from the company, and it's still losing money today as we speak, although it's 100 billion market cap. It's still losing nearly $1 billion at the EBIT level and the profit level. So they're kind of companies we find hard unless we can see profit, say, within 2 years. So Spotify, we could just see that, but saw it too late. And AppLovin, we could see it and it happened before our eyes, and then we benefited from that. But this business, it generates cash flow, but just doesn't generate a lot of profit, and there is a bit of dilution. So that never made it in, and it's too large now for us to invest in because it's gone out of our universe.
And so when you say you can see profit in certain tech companies, but you can't see it here.
Well, we couldn't see it there. We couldn't see it there. The market still doesn't see it until, say, 2027 or 2028.
So I'm looking at its losses, and its losses have kind of, from 2020 to 2024, the losses meaningfully expanded every year. Is that what you mean by you can't see it? It wasn't going in the right direction?
Yes, that's right. It should be, exactly. That's exactly what we had as our concern, and that's why we didn't invest in it. If you look at other companies like a Spotify or, as you mentioned, Uber, or an AppLovin, their losses were shrinking, so the sales leverage was very real. So when they got $1 billion extra of sales, as this company has $1 billion of sales almost every year, it drops to the bottom line. Whereas in this instance, it's just not dropping through because costs keep rising, because they need to... Again, maybe it signals that it's very competitive market, so they need to invest in developers, or they need to give developers a lot of incentive. But there's something in the structure of the business which tells you that its moat isn't as large as the market thinks. What has happened, and one of the good things about this business is it is becoming a platform. It's not just Roblox as one game. So that's one way for it to get to that profitability point. You can see that happening. It feels like a long way off for us, and that's why we just didn't invest. But the share price has now exceeded our market cap range, so it's out of our world.
If it falls back down, do you re-look at it?
We do. Yeah, we do. We definitely do when things come down. We have bought things that have come back into our universe and then gone back out. And if the profitability indication improves, and if Fidelity gets a lot more positive on it, then we would get involved. We've always been a bit lukewarm to it, and that's what kept us away for all that time.
So as part of your process, you would never... If a company seemed to be like a structural money loser for a while, like out to 28,
3 years,
2030.
Yeah, 3 years losses, it's hard for us to...
It's just a hard no? Or,
it's much harder for us to... Yeah, it's much harder for us to get our head around it.
Yeah.
You've seen many businesses go from losses to profits. Carvana's another one that has
been a
and that's
wild
been
ride.
and that's been huge. The market horizon of 3 years is generally long enough, is what I'd say.
Okay.
So if you can see profits 3 years from today, the market will start to reward you even now. losses turn to profits within 3 years, it's harder. So you tend not to miss out on too many, but you do miss out on some for sure. And this is one.
Plenty more pitches to swing at, though.
Yes. Yes.
How do you decide or like separate, I guess, momentum and hype from true underlying fundamentals?
It's a very good question. This is, especially in our world, it's a very good question. And we tend to you got to look at both financials and the market. So the duration argument in the numbers is what I've just said. It's about the 3-year profitability. You generally, if you've got an idea, sometimes it can take 5 to 7 years to get to profitability, but you can start to see it, and you can start to see there's some leverage. But when something is hype, it looks like that in terms of the share price is going up a lot, the share count's going up a lot, and the losses are basically either increasing or they're not going down. That tends to be when we get concerned that this looks like hype and momentum. And the share price is either running on top line sales, and we're going back to tech bubble, like people are looking at either eyeballs or top line, and there's not a real focus on profitability. And that's when we get major concern that that's basically a hype story. Yeah, I'm going to forget when I was in Fidelity in Boston, this is 20 years ago, one of the fund managers, he just said, James, just be careful when the two things are going up, which is your share price and your share count. That's when you got to really worry that there may be a momentum story.
Okay.
And that's probably still true today. That you have the share count and the share price is the two things that are going up. Then it's a worry. You should be getting profitability improving or your returns starting to improve. So that's when you get a bit of a signal. For us, quality versus momentum is a very big thing you got to break up, and quality should have generally 3 to 5 years of very good profits. So 15% return on capital should be there on a persistent basis. And when you think about structural winners or beautiful compounders, that's the profile that they have. And it's also the distinguishing between momentum and innovators. And that's the tricky thing, because the innovators are the one that move from an idea and momentum into something that's a profitability and a business. And that's when share prices can go up 5x, but then hold and then go even higher. Because their returns on capital can be very, very positive, and in like in AppLovin's case, it's top 1% of the world. Be a 50% return on capital business. That's top 1% of the world, because the average is around 10 and top quartile is above 12 or 13.
Right.
So to be even over 20 is like top 10% of the planet.
Wow.
So this is why finance, like at the end of the day, it's an amazing thing where everyone's trying to make money, but everyone gets pulled back into the returns on capital in competition, and that crowds you into a sort of average. But when you get these standouts, and that's why you don't want to be too like, it's momentum done, and just dismiss it, because you can come back in a year and it can be a very different outcome, a very different story, a very different set of financials. And that's a whole bunch of human beings that have developed a concept which is generating returns, which are top 20% of the planet in the finance industry. So it's amazing to always. That's why you should always come back to these things and see what the update is in terms of the numbers and the management story, because they can change quite dramatically.
Well, I want to move to a second company that is no longer in your portfolio.
Yes.
And James, it's hard to find winning stocks sometimes. There's a lot of duds out there. And when you find a winning stock, you want to let it ride. And you found a stock that has been, it's grown meaningfully. It's grown its profit margin from in the 20% to in the 40% while it's grown its revenue as well. Ticked a lot of boxes. You made 400% on this company. And then you decided to sell it. The company is Arista Networks. It's a supplier to large data centers, I believe. You found a winner. Why? What happened?
So it went out of our universe. So we have a true to label kind of test that allows us 12 months to sell. 12 months to sell once it reaches either out of the index or reaches that $50 billion US limit. This is a funny one, because with that 12-month limit, the lawyers will send us emails like,
really?
it's now out of index. It's now the clock's begun, and you have 12 months. And we sold it 2 days before that legal breach occurred. And during that period, it went up 90%.
Oh,
wow.
So it was
surely
definitely
you show the lawyers that and say, here's another 12.
Well,
Change
the timing was right. It's an amazing business, and you don't find these things, as you mentioned, very often. It's a picks and shovels of AI, which everyone knows what that word means today. Picks and shovels of AI and cloud, and also data centers. Very big topics today. Big clients like Meta and Microsoft. People have said, like, if you turn on Netflix, Zoom, or you turn on Facebook, all the data is going through something that's an Arista Network switch.
Right.
So it's a picks and shovels of all of those things that transfers data between your phone, the network, computers, and data centers. Look, this is one, if there's trust in an industry, and this is a very, very deep trust. If you are Meta, like, just think how massive that is in terms of data, you got to trust that a switch is going to work. It needs to be 99.99999% reliable, and it needs to be of a scale that means you could transfer data rapidly, quickly, and efficiently. And there's only like 2 or 3 companies in the world that can solve that problem, and Arista was one of them. So there was, obviously other competitors. The people behind Arista in terms of management are, very well known and very well seasoned tech icons in Silicon Valley. So they knew what they were doing from the beginning. They've, succeeded enormously. It's a huge market cap now. But to see these things, this is a beautiful compound. It fits all the profile. Had a 20% return on invested capital. And as I was mentioning, you can fit the industry on the palm of your hand. So if there's any trust in industry, whether it's engineering, medical, finance, legal, or tech, that you can fit the industry on the palm of your hand. And there's only 5 players. 5 players on the planet that can actually solve that problem for you, either as an individual, as a company, as a government, or as a country. That's a very powerful position to be in, and that's a very powerful business in the world. So to be in that position was huge. Financially, it was 20% return on invested capital, which is, as I mentioned, that's top 10% of the world. And it's an amazing business, management-wise, market structure-wise, returns, solving a problem, etc. So that's one of our beautiful compounders that, it has been an amazing stock.
You must have had a day of mourning when you had to sell it.
We got asked about it last week, and it was like, we cry for a little bit, and then we have to think of another one or find another one. So
have you found another one that good?
It's hard to find ones that good. I mean, AppLovin was really the one that replaced a part of Arista.
Okay.
Because we sold Arista a while ago, and AppLovin was kind of our new one, and that went up 500%. So that one has been like even beyond expectations. But the success of that has been huge as well. And often you only need a few in a portfolio to outperform the index, etc. But just phenomenal businesses, and very, very innovative, dedicated leaders that are doing something very differently in the world. And that's why their returns and the outcomes for the share prices, quite phenomenal. So just reflecting on Arista, my co-PM Maroon has actually published a note on the system called Unveiling Tomorrow's Titans, and it's actually a little case study on Arista and how we did make the investment and why, and even more detail of what I just mentioned here. And it is a classic future leader, and that is what we're trying to find. Tomorrow's Titans is what he's titled his note as. And that is what it is. It's just a great future leader of tomorrow that was once a $10 billion stock and is now a $100 billion stock. And it'll continue to go on, as it is the support for Meta and Microsoft. But that's what our goal is, to find these things. To let them ride to that $50 billion plus. And then go and find the next one.
I guess it complements people's holdings of Meta and Microsoft's rather than just overlapping with it.
Correct. And that gives you diversification away from those mega caps, which have been brilliant. So.
So we've spoken about 2 companies that aren't in the fund.
Yep.
Let's get to one that is in the fund. It is a London-listed company, Games Workshop.
Yep.
I remember our first book, shameless plug, that's our second book, Don't Stress, Just Invest. Our first book, Get Started Investing, we actually wrote about Games Workshop because that was published in 2021, and at the time it had been like one of the UK's best performing stocks over the past, I think, 5 years.
Yep.
So let's dig into it, because I'm excited to get an update on how it's going. Before we get into the financial story, let's talk about the business itself. So for people unfamiliar, what does Games Workshop do?
Games Workshop is a miniature figure producer, so it produces minifigures for the Warhammer series. and you can buy them. You get them delivered to your home, and you paint them all different colors, and then you ultimately have one character, and then you build out a whole board of characters. If you go to the shops, Warhammer shops, you'll see in the front what's called a diorama, which is basically a whole scene of characters that are painted, and then there's obviously all different kind of paraphernalia within that on a scene, whether it's a mountain or a war zone. That's basically what they do. They make those little characters.
Cult following.
It's a cult following,
Massive cult,
massive, especially in Europe. And the core demographic is actually 25 to 55-year-old males and middle to upper middle class. So it's basically a pastime, but definitely a cult following. In my day, going back and showing my age, Dungeons and Dragons was really big in terms of a video game, and this is kind of in that ilk of adventure, war. But it is a real cult following. People do love it. People do have nights where they have Warhammer nights, etc.
People can battle each other with them.
Yes, they battle each other. That's right, physically. So that's what it does.
Yeah,
that's what it does.
So what's the investment thesis, and I guess what boxes does it tick when you're looking for like a future leader? Yeah,
so this ticks all the boxes in terms of it's very unique. So this is, I guess, it will be part of the innovation kind of category, but it is also a beautiful compounder. So it has very high returns. So its returns since 2015 have been above 20%. As I mentioned, that's a very unique environment to be an above 20% return on invested capital business. It's been on that trajectory for at least 10 years. And that's why the last 10 years has been where the share price has gone up a lot since 2015, 2016. And the metrics are very good in terms of returns. The sustainability is very high because it is a very cult following. They're very deep sort of love for this brand. The love for the product is very deep. The balance sheet looks really good in terms of credibility. It's very high. Management are very thoughtful. Their annual reports are like, if you read them, they're very respectful of investors and shareholders and what they're doing. And then the recent big uplift in terms of the financial outlook for the business is it's going off the board game into games. It's already gone into games. So Henry Cavill, the Superman actor, he is quite a big gamer. And my son's mentioned this to me because he's often promoting the Games Workshop Warhammer game, and he's quite a big gamer himself. But he's now also gone into the movies, so done a deal with Amazon Prime. And so Games Workshop is going from the board game to the computers and gaming, and now into the movie sets and going to an Amazon Prime series. So they're building that series, which is due for 26 or 27. There's no details provided, but it will provide a significant uplift in terms of attention and awareness of what Warhammer is. And very similar to, people make analogies to the Marvel Cinematic Universe, where it went from the comics into the movies. This is going from the board game into the movies. And each character, like all of the Marvel characters, have backstories, which you can elaborate and make into a whole series of series, and there could be quite a big a whole series of time in terms of releases of movies in different characters on different sets, different battles, etc. The details, as I said, are not known. I was actually in Jersey in the UK earlier this year, and the Henry Cavill was actually from Jersey, which is an island off the UK, and actually went past the Warhammer shop that he actually bought his first Warhammer characters from. Wow. And when the movie started to become known and there was a bit of a release, he actually, said this is my Warhammer shop. So, quite an amazing story for a little boy who bought, little characters in his early years. He's now running the movies right into Amazon for Warhammer and Games Workshop. So, look, it's got a lot of dimensions to it. It's had a huge run, which is good. But there's a lot of really good things that are going for Games Workshop right now. So it's still in our portfolio now.
How long have you held it?
We've held it for over 2 years, for about 3 years. And we held it for those financial strengths. And then the movie sort of concept came about, which was just a bit of an add-on. But it's been very strong, very consistent, very sort of stable business. So that's why we do like it. It fits our beautiful compounder kind of profile.
Nice. I mean, I'm having a look at its financials. In the past 10 years, it's gone from about 100 million pounds in revenue to over 600 million, while expanding its margin from 11% to over 30%.
Correct.
So
Yeah.
you can see why you like it.
Yes. Yeah.
I guess, but before you explain the Amazon Prime conversation, my question was going to be, how big could Warhammer get?
Yes.
It feels niche.
Yes.
So like, is the thesis really tied in with the success of the TV and movies?
Yes, and that's what sort of started to concern us, which is why we kind of trimmed a little bit, because the excitement around what it could be has grown a lot, because the world has seen Disney buy Marvel, and Marvel has brought out, you know,
1,000 movies.
yes, 1,000 movies, and they're all, and some of them are great. Endgame, etc., Spider-Man, Iron Man, etc. And these are characters and merchandising, which has been massive. So can Warhammer get there? We don't know. Just the market knows that it can be big, and the market has got very excited about it. So that's why, our fundamental purchase, that 2-3 years ago was really about the board game and the stability of that board game. Even forgetting the movie, that could transfer to America, and then America could actually become another whole market in terms of a total addressable market for them.
Is it not as big in America?
It's not as big as in America at all now.
Okay.
So it's not that big. So that's why that could open up that whole world as a cult following as well in the States. And if that happens, that will be significant just for the board game. And then the movies would be on top of that. Time will tell. We've got a little bit more cautious more recently because of that fact that the multiples have gone up a lot. It's really expanded in terms of its expectations. But it has been a great business that we've owned, and it's still in the portfolio today.
Nice.
Over that 2-3 year period that you were holding, like, how do you think about deploying cash into it?
We've basically been topping up, because when we did buy it, we bought it as a smaller position, and then we've added to it. And it ended up being one of our top 3 positions because of the share price move, plus the small top-ups that we did after good results, etc. Now we've sort of pulled back a little bit because of that. So deploying the cash, we've been trimming more recently because of that fact that it's done very, very well. So that's fine that it's done well, and that's good. But then we just don't want to get too greedy and say, look, the movie is exciting and the board games is exciting and the multiples on 40 times, and that's great. Because expectations have risen a lot.
Yeah.
So, it's hard to redeploy new capital into that at the moment.
Love it. Well, James, some fascinating stocks that are both in the fund and not in the fund today. So we always love it when experts bring plenty of examples. And, from AppLovin to Roblox to Games Workshop, I feel like we've covered a lot today. So thank you for that.
Thank you.
Keep looking for those future leaders, because we want to hear about them.
Yes.
And, if you find another Arista Networks, feel free to just drop us a message as well.
Yeah, that's the goal. We spend our life trying to find those things. That's our goal every day.
So we'll include a link to Maroon's report in the show notes, as well as a link to the fund. But we really do appreciate you jumping on Equity Mates today.
Great. Thank you very much.
Thanks, James.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.